So this is session six of the Private Equity Foundation's practicum, right? So beginning with this session, we're going to more or less transition from the foundational concepts covered throughout the boot camp and the earlier practicum session into a series of real world case studies, right? So the goal of these case studies is to help you develop the practical skills needed to develop, to evaluate lower middle market opportunities, lower middle market investment opportunities across different industries and business models, right? So throughout the next several sessions, we'll be reviewing the SIMs and discussing how investors think about opportunities, identifying key diligence areas, and evaluating real businesses through the lens of a private equity investor, right? So for each case study, I will walk through the SIM in detail and discuss how an investor might evaluate the business. We will review the company's strategy, the industry dynamics, growth opportunities, financial profile, key risks, and also diligence considerations. Similar to our previous case study, I will also walk through the financial information provided in the SIM and discuss how those financials support or potentially challenge the investment thesis, right? And following each session, you'll receive an assignment where you will be expected to apply the concepts that we have covered throughout the boot camp and the practicum. And the assignments are designed to simulate the type of work that investment professionals perform when evaluating acquisition opportunities. But as part of the assignment for the case study, you will also be expected to build and analyze your own LBO model based on information provided, right? So rather than providing a completed model during the session, I wanted to begin thinking through the assumptions, drivers, and analytical frameworks that would be required to evaluate the transaction itself. Very similar to what we did with the ProCare case study, right? And one of the objectives of the practicum is to expose you to a broad range of industries, right? So business models and transactional situations, right? Because no two deals are exactly alike. So healthcare services business that we saw before may have different drivers than a technology consulting business, a manufacturing company, business services platform, or a consumer product company, right? So through these case studies, we will work to build competency across a variety of sectors and transaction types so that you become comfortable evaluating the different opportunities commonly encountered in the lower middle market. So basically, as we move through each case study, I encourage you to think like an investor, right? What makes the business attractive? What are the risks? Where are the opportunities for growth? What diligence questions would you ask? And ultimately, would this be a business worth pursuing further? So in today's case study, it focuses on TechNova Solutions, which is a technology consulting and IT services business. As we review the SIM, I wanted to think about how the company generates revenue, what drives its competitive positioning, whether the growth initiatives appear achievable, and where a private equity investor might see opportunities to create value following an acquisition, right? So with that context, let's begin by taking a look at TechNova Solutions. And again, as we begin review with the SIM, I wanted to approach this the same way an investor would when receiving a new opportunity for the first time, right? At this stage, you're not trying to make an investment decision. Instead, you're trying to develop an initial understanding of the business and determine whether the opportunity warrants further attention, right? So as we work through the SIM, pay attention to how management presents the company, the growth story that's being communicated, the key investment highlights, and also the value creation opportunities being identified. And one of the important things, again, to remember is that a SIM is ultimately a marketing document. So its purpose is to present the business in the most favorable light possible while highlighting the attributes that management and the seller believe will be most attractive to potential investors. So as investors, our job is to, again, understand the story being presented, but also to think critically about the assumptions behind the story. What appears compelling? What would you want to validate through the diligence? What additional questions would you want to ask, right? So again, with that mindset, let's begin taking a closer look at TechNova Solutions. This is the usual disclaimer page that we've seen before when we did the ProCare Health about GEX Academy. This is a fully anonymized course, but we still are looking at real deals, but anonymize it for the purpose of this program. We have a typical table of contents here, nothing to see here. So we really start with the company introduction here, right? So let's start by understanding what TechNova Solution actually does. So whenever I'm reviewing a new opportunity, one of the first questions I ask is whether I can clearly explain the business in one or two sentences. So if we cannot quickly understand how the company makes money, who it serves, and what value it provides to customers, that is usually a sign that I need to dig deeper before moving forward, right? So in TechNova's case, the business operates in the technology consulting and IT services space. The company builds organizations, execute technology initiatives by providing software development, systems integration, IT staffing, cloud transformation, and other digital modernization services. So what I like about this business model is that it sits at the intersection of two attractive areas. First, companies continue to invest heavily in technology modernization, cloud migration, cybersecurity, and digital transformation initiatives. Second, there remains a significant need for specialized technical talent, which can be difficult for many organizations to recruit and retain internally. Now, of course, AI is starting to become a big factor, and that's also affecting talent acquisitions. But these are things to think about when we look at something like this and see how relevant and what are the risks or what are the weaknesses that you may encounter when you look at an opportunity like this, right? So as you look through the company snapshot section, notice the diversity of services and markets being served, right? The business doesn't seem to be dependent on a single industry or customer segment. Instead, it has exposure across government, healthcare, technology, financial services, and other enterprise customers, right? So generally speaking, diversification like this can reduce concentration risk and create multiple avenues for future growth. The next thing I pay attention to is the recurring nature of customer relationships. So technology consulting businesses can vary significantly in quality depending upon whether they are relying on one-time projects or have long-standing client relationships, all of which can generate repeat business, right? So as we see through the sim, management is emphasizing that a meaningful portion of the revenue comes from recurring engagements and multi-year customer relationships. I also want you to focus on the investment highlight section over here. So whenever you're reviewing a sim, these highlights provide insights into the seller's investment thesis, right? So in other words, they're telling you why they believe this business is attractive and why a buyer should be interested. So as investors, our job is to evaluate whether these claims are reasonable and supported by the underlying data. Finally, you notice the strategic growth opportunity section at the bottom. So this is really the core story management is presenting, right? So the argument is that business has established customer relationships and existing opportunity flow, but that growth has been constrained by recruiting capacity, delivery resources, and infrastructure. So the implication is that with additional investment and operational support, the company could pursue a much larger share of the opportunities already available within its existing ecosystem, right? So as we move into the next few slides, we're going to start examining that growth story in more detail, and we will determine whether the opportunity appears realistic and achievable. So more to the next few slides, we're going to start examining this, right? So now let's look at what I could consider a very important slide in the sim, right? The current opportunity capture versus the revenue expansion potential slide. So at its core, this is attempting to answer a very simple question. Where does future growth come from? So one of the things management is communicating here is that they believe that the business is currently operating below its full potential. So according to management, the company already established the client relationships, the vendor program participation, and market access necessary to support a much larger business. The challenge is not necessarily generating demand, but rather having the capacity and infrastructure to pursue a greater portion of the opportunities already available to them, right? So if you start on the left side of the slide, you will see the current state section. The company highlights several strengths that it already possesses today, right? First, it has strong existing client relationships, which is important because it means growth may not require building an entirely new customer base from scratch, right? Second, the company already participates in various vendor programs and has established credibility with its customers. And then third, the management emphasizes a proven delivery track record, suggesting that clients are already comfortable engaging the company for technology initiatives and staffing needs. However, if you look at it, the management also identifies several constraints, right? The first is you have limited recruiting capacity. So we will discuss through the case study. Technology consulting and staffing businesses are often constrained by their ability to source and place qualified talent. You can only grow as quickly as you can recruit and deploy resources. The second constraint is what management describes here is a leadership dependent delivery model, right? So in many small businesses, growth can become constrained because too many decisions and responsibilities can remain concentrated with a small number of key individuals. We talked about it during the ProCAT case study, the key man risk, right? So now then we are focusing on the revenue expansion bridge, which is kind of in the center of the slide, right? So notice that the management is not suggesting that the growth will come from a single initiative. Instead, they identify multiple drivers which collectively contribute to the opportunity, right? So, of course, the first driver you look at it is the client expansion. Is often one of the most attractive forms of growth because it involves selling additional services to customers who already know and trust the company. Existing customers typically require less sales effort, and they often have lower acquisition cost than entirely new customers. So that's super key. Another driver is recruiting infrastructure. So if management is correct, the talent acquisition is a bottleneck, then investing in recruiting processes, systems, and personnel could allow the company to pursue a larger volume of opportunities, right? The third driver is delivery capacity expansion. So it ties closely to recruiting, but also includes building the operational infrastructure necessary to manage more projects, support additional clients, and also reduce dependencies on senior leadership, right? And then finally, the management, it also highlights expanded service offerings, right? So as companies deepen relationships with clients, they would often identify opportunities to cross-sell additional services and increase the wallet share within existing accounts. So that's super key. And then on the right side of the slide, you see management outlines the actions that they believe can unlock this growth opportunity, right? So it includes expanding the recruiting engine, increasing the delivery capacity, improving opportunity response rates, deepening client penetration, and also pursuing larger contract opportunities, right? So what's important here is that the management is presenting a fairly logical value creation story, right? So they're not claiming that revenue will double overnight. Instead, they're arguing that operational improvements can enable the company to capture opportunities that already exist within its current ecosystem. So if as investors, this is where our diligence mindset begins to kick in, right? So we need to ask ourselves whether these bottlenecks are real, whether the proposed solutions are achievable, and whether management has evidence to support the assumptions that are being presented. If the answers are yes, then this slide becomes much more than a growth story, right? It becomes a roadmap for the value creation following an acquisition, which is exactly what private equity investors are looking for when evaluating a lower middle market opportunity. So I'll take a quick pause here. Either of you guys have any questions so far? Okay, great.
All good.
Awesome. So moving on to the next slide. So again, before we move on to the growth story and financial discussions, right? It's important to understand the underlying problems that TechNova is helping its customers solve, right? One of the things that private equity investors spend a lot of time evaluating is whether a company is solving real business problems that customers are willing to pay for, right? So the more critical and persistent those problems are, the more valuable the company's services tend to become. So the first challenge highlighted on this slide is inefficient hiring and project staffing. So many organizations know that they need additional technical resources, but then they struggle to identify, evaluate, and deploy qualified professionals quickly enough to support critical initiatives, right? So lengthy hiring cycles, inconsistent recruiting processes, and limited candidate networks, all of that can delay project and constrain growth. So TechNova helps address the challenge by rapidly sourcing and deploying qualified technology professionals throughout its recruiting platform and candidate network, which is interesting. So the second challenge is the broader shortage of skilled technology talent, right? So across the market, demand continues to exceed supply for software developers, cloud engineers, cybersecurity specialists, data professionals, and these days AI professionals, right? And a lot of other highly technical resources. So this talent gap creates ongoing demand for firms which already have established recruiting capabilities and access to qualified candidates. And the third area involves operational and project execution challenges. So even when organizations have the necessary budget and strategic objectives in place, technology initiatives can suffer from coordination issues, staffing shortages, lack of technical oversight, or project management challenges, right? So these execution risks can lead to delays, cost overruns, and failed implementation. So TechNova helps clients assemble and manage the technical resources needed to improve the execution outcomes, which is very, very insightful. The fourth challenge here is, of course, technology modernization. So many organizations continue to operate on legacy systems and fragmented technology environments, right, which limit scalability, they limit productivity and competitiveness. So as companies invest in cloud migration, systems integration, application modernization, broader digital transformation initiatives, the demand for specialized technical expertise continues to grow. So that is key. And then the fifth and the final challenge highlighted here is really the limited data utilization. So most organizations collect significant amount of data, but many struggle to transform that information into actionable business insights. So having data is not the same as leveraging it effectively, right? So this kind of creates a demand for analytics specialists, data engineers, and technical consultants who can then help organizations improve decision making and operational performance, right? So as investors, what should stand out is that each of these challenges represents a long-term demand driver rather than shorter-term demand, right? So, or shorter-term trend rather. Organizations will continue to need talent, modernization, execution support, staffing solutions, and data expertise. And that creates a favorable backdrop for companies like TechNova, which are positioned to address those needs. So this slide is helping us understand why customers engage the company in the first place. So as we move through the rest of the sim, we will then begin evaluating how effectively TechNova has built the capabilities around solving these challenges and whether those capabilities can support future growth and value creation, right? So that's kind of what we looked at that. Any questions so far? Right. So now that we've discussed the problems that TechNova helps to solve, right? So next logical question is, why would a customer choose TechNova instead of one of the many other staffing firms, consulting firms, or technology service providers that operate in the market, right? So this is where we begin evaluating competitive differentiation, right? So one of the things private equity investors are always looking for is evidence that the company has developed capabilities which are difficult to replicate or that create an advantage in winning and retaining customers. So the stronger those advantages are, the more sustainable the company's growth and profitability can become over time. So the first differentiator highlighted here is TechNova's scalable recruiting engine and talent network, right? So as we discussed in the prior slides, finding qualified technology professionals still remain one of the biggest challenges organizations face today. What management is arguing here is that TechNova has developed a structured recruiting process and candidate pipeline that allows the company to identify and also deploy qualified technical resources a lot more efficiently than many competitors can. And this is important, right? Because in technology staffing and consulting businesses, right, speed often matters. If a client has a critical project that needs resources immediately, the firm that can deliver qualified candidates the fastest often wins the engagement. So the ability to consistently source and place talent becomes a huge competitive advantage in itself. The second differentiator is data-driven recruiting and delivery management, right? So if you look at it, the management emphasizes the use of recruiting systems, candidate pipeline tracking, placement metrics, and operational monitoring. So all of this suggests that recruiting is not being managed solely through relationships or intuition. Instead, the company is using data and performance metrics to improve sourcing effectiveness, optimize recruiting channels, and monitor outcomes. So as investors, we generally like to see businesses that utilize data and process discipline because it can improve scalability and reduce dependence on individual employees. And then look at the third differentiator is the company's flexible technology staffing and project support, right? So the kind of a model. So many staffing firms focus exclusively on placing candidates and then moving on to the next engagement. TechNova is presenting a slightly broader value proposition, right? So in addition to staffing solutions, the company is also supporting project-based delivery initiatives, right? Allows clients to engage the business in multiple ways depending on what their needs are. So from a customer perspective, that flexibility can be attractive, right? Because it creates a one-stop solution for both talent acquisition and project support. And the final differentiator here highlighted here is a strong client relationship and repeating engagements, right? So as investors, it is often one of the most important differentiators to evaluate. If you have long-standing client relationships, they can create recurring revenue opportunities, lower customer acquisition costs, and also increase revenue visibility, right? So they also serve as evidence that the company is delivering value to its customers. So when I look at this slide, I don't view those four areas independently, right? So rather, I think about how they work together. A strong recruiting engine helps attract talent, data-driven processes improve efficiency, flexible service offerings expand the company's value proposition, and strong client relationships help generate repeat business. So collectively, these capabilities form what I would call the foundation of TechNova's competitive position. And then again, as we continue through the sim, we will start looking for evidence which supports these claims, because identifying competitive advantages is one thing, but demonstrating that they translate into sustainable revenue growth and customer retention is really where the real investment thesis begins to take shape. So any questions so far? Okay. So now at this point, we are somewhat shifting from understanding the business model to really understanding the organization behind the business, right? So sorry, I'm just, I don't know why. Yeah. Oops, do that again. Okay. So whenever I review an organizational chart, right, one of the first things I'm trying to determine is how dependent the company is on, again, a small number of individuals. So in many lower middle market businesses, the founder or owner is deeply involved in sales, client relationship, recruiting decisions, operations, and overall management, right? So while that level of involvement can help drive the growth in the early stages, it can also create scalability challenges as the business become larger. And we saw a lot of that happening in the ProCare Health Services deal, right? But as you review the org chart, think about how the responsibilities are distributed throughout the organization. Are there dedicated leaders overseeing recruiting, operations, project delivery, and client management, right? Or is most of the decision making concentrated with a single individual? So for a business like TechNova, recruiting and talent management are particularly important functions, right? Because the company's ability to grow is closely tied to its ability to identify, recruit, and deploy qualified technical professionals. So as a result, investors will typically spend a significant amount of time evaluating the recruiting organization, management team capabilities, and operational processes that support the continued growth. Another area investors often focus on is really management debt, right? So if the company were to double in size over the next several years, will the existing org structure support that growth? Are there future leadership positions that may need to be added? And are there areas where additional middle management or operational infrastructure could actually improve scalability, right? So one thing I wanted to keep in mind is that investors are rarely looking for a perfect org chart. In fact, many lower middle market businesses have opportunities to strengthen their management infrastructure. But what investors care about is understanding where those opportunities exist and whether they can be addressed as part of a value creation plan following an acquisition, right? So as we continue through the sim, pay attention to areas where management highlights recruiting capabilities, operational processes, and scalability initiatives. And many of those themes tie directly back to the org structure that we're looking at over here, right? So obviously, as you go through the process, there's going to be a lot more due diligence. There are going to be management meetings. There's going to be a better understanding of how a lot of these individuals shown over here across operations, human resources, finance, recruiting, and so on and so forth, how important they are and how much of ownership are they taking in terms of managing responsibilities and delegating things away from the CEO over here. So those are things that you want to probably take into consideration while continuing your due diligence process through the management presentations and beyond that, right? So that's really what we're doing here. So this slide, it brings together many of the themes that we've discussed throughout the sim. And it also begins to articulate the overall investment thesis for the opportunity, right? So as investors, we're always trying to understand not only what a company does today, but why it may be positioned to create additional value in the future. The slide highlights 5 areas that management believes is the growing demand for technology talent. So across virtually, the first investment highlight is a growing demand for technology talent, right? So across virtually every industry, organizations continue to increase spending on technology initiatives, whether it's cloud infrastructure, again, cybersecurity, artificial intelligence, software development, data analytics, or enterprise systems. Companies are increasingly requiring highly skilled technical professionals to support these initiatives. And one of the key arguments management is making here is that this demand is being driven by long-term secular trends, rather than short-term market conditions, right? So as technology becomes increasingly important to business operations, the demand for specialized talent is expected to remain strong. The second investment highlight here is recurring demand from enterprise technology initiatives. Unlike many project-based industries where work can be highly transactional, technology initiatives often create ongoing demand. Enterprise software implementation, infrastructure, modernization efforts, cloud migration, cybersecurity programs, and application development projects, all of them frequently require support over extended periods of time. So as a result of that, once a company establishes itself with a client, there are often an opportunity to generate repeat engagements and recurring revenue streams, right? So from an investor's perspective, recurring demand is generally attractive because it improves the revenue visibility and also reduces dependence on constantly acquiring new customers. So that's super important. The third investment highlight here is scalable recruiting infrastructure, right? So we discussed this earlier. Recruiting is a critical capability within a technology staffing consulting business. Management here believes that TechNova has developed a structured recruiting platform and a talent sourcing process which is capable of supporting future growth. So if you continue to invest in recruiting infrastructure, candidate pipelines, and delivery management processes, the company here believes it can increase placement volume. It can also improve responsiveness to clients and also support a larger scale operation over a period of time. So that's again a very, very key investment highlight. The next highlight is a significant opportunity within the existing client base, right? So one of the most important aspects of the growth story. Management's argument is that TechNova currently pursues only a portion of the opportunities available through its existing client relationships and vendor programs. So in other words, there may be substantial room for growth without relying entirely on acquiring new customers, right? So as investors, we generally view expansion within existing relationships as a lower risk growth strategy because the customer relationships have already been established and the company already has a proven track record with those clients. So that's super key. And the fifth and the final investment highlight here is that the company's position as a platform of strategic growth. So management again believes that the business has already established many of the foundational elements necessary for future expansion. That includes client relationships, recruiting capabilities, operational infrastructure, and industry expertise. So the basic thesis here is that with additional resources, capital, and strategic support, the business could accelerate growth and expand into a broader set of opportunities across the technology services landscape. So when you weave this together, these five highlights, investment highlights, they seem to form the core investment thesis that is being presented in the sim, right? So there's a large and growing market, there's a recurring demand from clients, scalable recruiting capabilities, additional growth opportunities within the existing customer base, and also there's a platform that management believes can support future expansion. So again, as we move through the rest of the section of the sim, we will again evaluate whether the underlying data and operating performance support those claims and whether the opportunity is as attractive as management believes it to be. Taking a quick pause here. Any question, guys? Okay, so moving on to the service offerings, right? So basically, one of the things investors typically evaluate, right, when reviewing a technology consulting and services business is basically the breadth of its service offerings, right? So a company that participates in multiple areas of technology spending, they often has more opportunities to grow, to cross-sell services, and also to deepen client relationships over time, right? So the first service area highlighted here is the technology strategy and advisory. So many organizations understand that they need to modernize their technology environments, but they may not always know where to start. So as a result, they often engage consulting firms to help define technology roadmaps, evaluate investment opportunities, assess existing infrastructure, and also align technology initiatives with the broader business objectives, right? So these advisory engagements can be valuable because they often position the service provider to participate in future implementation work as well. So that's super key. The second service area here is a digital transformation and cloud solutions. So it's one of the largest and fastest growing areas within technology services, right? So organizations across virtually every industry continue to migrate applications to the cloud, modernize legacy systems, automate business processes, deploy new digital platforms, especially with AI. Right. So these initiatives are often multi-year projects that require specialized technical expertise and significant implementation support, right? So from an investor's perspective, this area is attractive because it is supported by a long-term technology spending trends rather than short-term economic cycles. So many organizations are still early in their modernization journey, so which creates ongoing demand for these types of services. The third service is it's very the hot topic these days, right? Data and artificial intelligence solutions, right? So over the last years, especially with AI, data analytics and artificial intelligence have become a major priority for organizations across industries. Companies collect enormous amount of data, but many struggle to transform that information into actionable insights that provide improve decision making and business performances, right? TechNova supports clients to services that includes data engineering, analytics, machine learning solutions, AI-driven automation and data platform implementation. It also seems to represent pretty attractive growth opportunity because AI and advanced analytics continue to receive significant investment attraction right across both private and public sector organizations. So it's obviously a very important area, and looks like Technova is working towards that investment thesis. And then the fourth service area here focuses on cybersecurity and technology risk, right? So as businesses become increasingly dependent on technology, cybersecurity continues to grow in importance. Organizations face constant threats related to data security, regulatory compliance, ransomware attacks, operation disruptions, right? So as a result, demand for cybersecurity assessments, security architecture design, risk management, and ongoing monitoring services, all of them have increased substantially over time. Cybersecurity in particularly is very interesting, right, from an investment perspective, because spending in this area tends to be relatively resilient. Organizations may delay certain technology projects during periods of economic uncertainty, but they generally cannot afford to ignore cybersecurity risks. So as investors, what I want you to notice is that these service offerings are highly complementary. A client may initially engage the company for technology advisory work, which could then lead to a client migration project, the cybersecurity initiatives, staffing requirements, data analytic engagements, or broader digital transformation efforts, right? So all of this creates opportunities for cross-selling and deeper client relationships over time. Rather than viewing these as four independent service lines, investors would often evaluate how these capabilities work together to create a broader technology services platform, right? So as we continue through the rest of the sim, we will again begin examining where revenue is generated today and whether these service areas provide meaningful opportunities for future growth and expansion. Um, Taking a quick pause, guys. Any questions for me? Great. Moving on to the next. So again, another important component of Technova service offerings focus on workforce enablement and technology talent solutions. So one of the themes that you'll notice throughout the sim is that the company is not simply providing technology consulting services, right? So a significant portion of the value proposition revolves around helping organizations access, develop, and deploy technical talent more effectively, right? So the first service area highlighted here is the technical talent solution. So many organizations need highly skilled technology professionals to support software development initiatives, cloud projects, infrastructure upgrades, cybersecurity programs, and enterprise system implementation. But finding qualified talent can be both time consuming and expensive. So Technova helps clients address this challenge by leveraging its recruiting network, candidate sourcing capabilities, and screening processes to identify professionals who can contribute quickly to critical initiatives. So again, from a client perspective, provides access to specialized expertise without the delays and uncertainty often associated with traditional hiring process. So another service they're talking about is the strategic hiring and direct placement, right? So while some clients require temporary project support, others are looking to build permanent internal capabilities, right? So Technova assists these organizations by identifying long-term technology leaders and specialists who align with both those technical requirements and cultural environments of the business. So this seems to be important again because permanent placements often create deeper client relationships, and they also position the company as a strategic partner rather than simply a staffing provider, right? So successful placements can very often generate repeat business as clients return to company for the future hiring needs. Another service area is enterprise systems and application support, right? So organizations increasingly rely on complex enterprise software platforms to manage critical business functions. So these systems often require implementation support, integration services, modernization efforts, and ongoing maintenance and technical expertise. Technova assists clients with ERP and CRM implementations, application modernization, system integration, and ongoing support, right? So by helping organizations optimize these technology platforms, the company now becomes embedded in important operational initiatives that can lead to longer term client relationships and recurring engagement opportunities. The fourth area is talent pipeline and skills development, right? So one challenge currently facing many technology focused organizations is the ongoing shortage of qualified talent. So rather than simply reacting to hiring needs as they arise, Technova wants to proactively develop a pipeline of future candidates again, through training initiatives, certifications, and practical experience, right? So from an investor perspective, again, it's an attractive capability because it helps strengthen the company's talent supply, but also creating additional scalability within the recruiting platform. A larger and more qualified candidate pool can also improve placement volume and responsiveness to client demand over time. Again, as investors, what I want you to notice is that these service offerings work together to support a broader workforce and technology enablement platform. The company can help clients identify talents, hire permanent employees, support critical enterprise technology systems, and also develop future talent pipelines. So it creates multiple avenues for engagement with the existing clients and also provides opportunities to expand the relationship over time. So rather than generating revenue from a single service line, TechNova is really here positioning itself as a broader technology workforce and enablement partner. So as we move through the remainder of the sim, we'll continue evaluating, right, these capabilities, how do they contribute to revenue generation, client retention, and so on and so forth, the growth strategy. So that's, again, super helpful to understand from TechNova's perspective. Any questions on this section, guys? Okay, cool. Let's move on to the next one. Right. So it's another important area of the service offering, technology risk and security solutions. Again, investors get very excited about this, right? So one of the realities of today's business environment is that organizations are becoming increasingly dependent on technology to operate. As that dependence grows, so does the importance of protecting the systems, applications, data, critical infrastructure, right, from both internal and external threats. So as investors, one of the reasons we pay attention to cybersecurity and technology risk services is because these areas tend to be driven by necessity rather than discretion. Organizations may choose to delay certain technology investments, but they generally cannot afford to ignore security risks, compliance requirements, or operational vulnerabilities, right? So that's super key for investors. The first service area highlighted here seems to be the security and risk diagnostics. So before organizations can improve security, they first need to understand where the risks exist, right? So TechNova performs structured assessments of infrastructure, applications, data environments, broader technology ecosystems to identify vulnerabilities and operational risk. So these assessments help clients understand potential exposure points and also prioritize remediation efforts, right? So from a consulting perspective, diagnostic engagements often valuable because they can lead to additional implementation and support work once improvement opportunities are identified. So it's super important. The second service area here that they highlight is the data protection and application security, right? So obviously protecting sensitive information has become a major priority for organizations across virtually every industry. So companies must secure customer data, employee information, intellectual property, and critical business systems, while also maintaining compliance with the various regulatory requirements. TechNova supports clients through data protection strategies, application security frameworks, compliance initiatives, and also threat monitoring capabilities, right? So by helping secure both application infrastructure, the company can assist clients in maintaining operational continuity while reducing security-related risks. So it's super important. The third service area here that they highlight is the threat response and security remediation. So even organizations with strong security programs will encounter vulnerabilities and emerging threats, right? So the key is having the ability to identify issues quickly and also respond effectively before they become significant operational problems. So TechNova assists clients with, remediation planning, systems hardening initiatives, security policy development, and also incident response coordination, right? So these capabilities, all of them help organizations strengthen their security posture, but also building long-term resilience against future threats. The fourth area is identity governance and access management, right? So one of the most common causes of security breaches is unauthorized access to systems and sensitive information, right? So as organizations grow more complex and employees access applications across multiple environments, managing identities and permissions becomes increasingly important. So TechNova, they help clients implement identity governance frameworks, authentication controls, access management policies, and single sign-on capabilities, right, which strengthen security while also improving user experience. And these solutions help reduce the insider risk and also provide greater control over who can access critical systems and data. So if you're looking at investors, what I want you to notice is that these offerings again cover multiple stages of the cybersecurity lifecycle, right? So the company helps clients identify risks, protect critical assets, respond to security incidents, and manage user access. Kind of creates a more comprehensive service offerings than simply providing a single security solution. It also again creates opportunities for recurring engagement. So security is rarely a one-time project. Organizations continuously evaluate risks, update controls, or monitor threats, and strengthen defenses as technology environments evolve. So, from an investment perspective, it is going to be attractive, right? Because cybersecurity spending is generally supported by long-term structural demand drivers, right? So, increasing regulatory requirements and also the ongoing need to protect critical business operations. So, as we go through the rest of the projects, right, think about how these capabilities complement the company's broader technology consulting and workforce solution platform, because together they expand the company's ability to serve clients across multiple areas of technology spending, right, and also create additional opportunities for long-term relationship development. Any questions, guys, so far? Great. So let's move on. Next, we're talking about market opportunity, right? So basically, up to this point, we have been spending most of our time discussing Technova specifically, right? So now we're going to zoom out and we look at the broader market environment in which the company operates. So one of the things PE investors spend a significant amount of time evaluating is industry attractiveness. So even if you have a well-managed company, it can struggle if it operates in a declining market, right? Conversely, a company operating in a growing industry may benefit from powerful tailwinds that support long-term expansion. So this highlights several of the major trends driving growth across the technology advisory and digital services market. One of the trends is the first trend is the continued acceleration of digital transformation initiative. Actually, they talk about it second, but it's a super important trend. Organizations across virtually every industry continue to invest heavily in technology modernization efforts. Businesses are migrating applications to the cloud, implementing new enterprise software platforms, automating business processes, adopting emerging technologies like artificial intelligence and machine learning, right? So all of these initiatives are often complex and they require specialized expertise that many organizations do not possess internally. So as a result, companies frequently engage consulting firms and technology service providers to help design, implement, and manage those transformations, right? So for firms like Technova, it creates a large and growing market opportunity because many organizations remain in the early stages of the digital transformation journey. The second trend is the increasing importance of data-driven decision making. Organizations today collect more information than ever before, right? However, collecting data is only valuable if businesses can transform that information into actionable insights. Companies are investing in data infrastructure, analytical platforms, BI, business intelligence tools, and predictive modeling capabilities to improve, decision making and also create, a lot of actionable insights, right? So a lot of companies are investing in these kinds of capabilities and improving and basically creating growing demand for organizations capable of supporting data architecture, right? Analytics implementation, artificial intelligence initiatives, and all kinds of consulting services. So we discussed in the previous slides, these capabilities align directly with several of Technova's service offerings. So that's super important. And then of course the next trend is the rising cybersecurity threat environment, right? So as organizations become increasingly digital, cybersecurity has become a broad level priority, right? So it's kind of very important for many companies and government agencies to attack and address. Threats continue to evolve in both frequency and sophistication, creating ongoing demand for security assessments, compliance initiatives, threat monitoring, risk management, incident response capabilities, right? So unlike some of the other areas of technology spending which may fluctuate with economic conditions, like I said before, cybersecurity spending is often viewed as a necessity rather than a discretionary investment. So organizations generally cannot afford to ignore security risks. So this becomes a very attractive area for long-term demand. So again, when we combine all of this together, a common theme emerges, right? Organizations continue to invest in technology modernization, data analytic capabilities, AI initiatives, cybersecurity infrastructure. These investments require, again, specialized talent, consulting expertise, implementation support, and ongoing operational assistance, right? So from an investment perspective, they're important trends because they help support the growth assumption that will may be embedded within the investment thesis, right? So management is essentially arguing that Technova operates in markets benefiting from stronger secular growth drivers, creating a favorable environment for future expansion, right? So as investors, we want to, however, distinguish between growth driven by company specific execution and growth supported by the broader industry tailwinds. And it seems like the most attractive opportunities often benefit from both, right? So the next few slides will help us to evaluate how Technova's positioning aligns with these broader market trends and also whether the company is well situated to capitalize on these opportunities moving forward. Any questions on the market? Right. Again, this focuses on another important market dynamics, right, which supports the investment thesis, which is the technology, talent, and staffing market, right? So the previous slide focused primarily on technology consulting and digital services. This slide highlights the broader workforce trends that are driving demand for firms capable of sourcing, recruiting, and deploying specialized technical talent, right? One of the reasons this is important is because many technology initiatives ultimately succeed or fail based on access to qualified people. So organizations may have budgets, they may have strategic objectives and approved projects, but if you don't have the right talent, execution becomes difficult. So one of the first trends highlighted here is the persistent shortage of skilled technology talent, right? So across the market, organizations continue to compete for professionals with expertise in areas like cloud infrastructure, cybersecurity, data engineering, AI, enterprise software. But in many cases, demand for these skills exceed the available supply. So it creates a favorable environment for companies like Technova because organizations increasingly rely on specialized staffing and consulting firms to help identify and deploy qualified professionals. Firms with established recruiting processes and strong candidate networks, they're often able to fill positions more effectively than clients that can they do that on their own, can do this on their own. So the second trend is the increasing adoption of contract-based technical talent, right? So historically, many organizations focus primarily on hiring, full-time employees to support technology initiatives. But today, if you look at it, right, companies are increasingly utilizing flexible staffing models that allow them to scale resources up or down depending upon the project requirements, right? So for organizations undertaking cloud migrations, cybersecurity initiatives, data modernization project or software implementations, contract-based talent can provide specialized expertise without permanently increasing the headcount. Again, from an investor's perspective, this trend is attractive, right? Because it expands the addressable market for staffing and consulting firms capable of rapidly deploying technical resources. So that's a very key trend in the market that we need to keep our eyes on. The third trend involves the expansion of technology projects within the government and regulated industries. So government industries, government agencies, healthcare organizations, and financial institutions, right, and there are other regulated sectors, they continue to invest heavily in technology modernization efforts. These projects, they often involve complex compliance requirements, cybersecurity consideration, regulatory oversight, right? So organizations operating in these environments frequently seek external partners that possess both technical expertise and also experience navigating regulated operating environments. As a result of that, consulting and staffing firms that understand these requirements can benefit from growing demand across the sectors. So that's another important trend. And the fourth trend they're talking about here is the aging workforce and the resulting replacement demand. A significant portion of the experienced technology workforce is approaching retirement age. Senior professionals leave the labor force. Organizations then start facing increasing pressure to replace institutional knowledge and maintain critical systems, right? So this demographic trend creates a long-term source of demand for recruiting, staffing, and talent development services. Companies need assistance identifying qualified replacements, right, while simultaneously also supporting technology modernization efforts. So what I want you to notice again is that these trends, again, like before, they reinforce each other. There's a shortage of specialized technology talent. Organizations are increasingly utilizing flexible staffing models. Technology spending continues to grow across government and regulated industries. And again, an aging workforce is creating additional replacement demand. Collectively, these factors, all of them create a favorable backdrop for firms that can effectively source, recruit, and deploy qualified technical professionals. Again, right? So from an investment perspective, This slide helps support the argument that Technova is operating within a market environment characterized by these strong demand drivers. And of course, the next step is determining whether the company has the recruiting infrastructure, their client relationships, and also the operational capabilities which are necessary to capitalize on these trends more effectively than these sims. So as we continue through the document, we'll begin connecting these industry dynamics to Technova's actual operating performance and growth opportunities. Right. So, any questions so far, guys? Okay, cool. So now, this is like the exciting stuff, right? So we're talking about value creation. So we're beginning to move from discussing all the market opportunities to discussing, potential value creation opportunities within the business itself, right? So one of the key themes that management highlights here is the opportunity to leverage international talent to expand delivery capacity, improve recruiting flexibility, and also strengthen the overall operating model, right? So as investors, we are always looking for opportunities where relatively simple operational improvements can create meaningful value. So, in many technology service businesses, talent is both the largest asset and one of the largest costs within the organization. So, as a result, improvements to recruiting capabilities, delivery capacity, and labor efficiency, all of them can have a significant impact on growth and profitability, right? So the slide begins by describing the company's current position, the existing position. Today, Technova primarily sources talent within the United States. There are many highly qualified professionals available domestically. Relying primarily on one geographical market can limit access to specialized skills and also constrain the overall recruiting pipeline. So management's argument here, it seems like, is that the company currently has access to more contract opportunities that it can fully pursue because recruiting capacity and talent availability can become limiting factors, right? In other words, demand may not be the constraint, talent supply may be the constraint, right? So this is an important distinction, right? Because investors generally prefer situations where growth is limited by internal capacity rather than by lack of customer demand. The proposed growth initiative is the expansion of international talent sourcing and recruiting capabilities, right? So many technology services firms have successfully built global recruiting and delivery models that provide access to highly qualified professionals across regions like India, Eastern Europe, Latin America, and Southeast Asia. So those markets often provide strong technical talent pools across software development, cloud engineering, cybersecurity, data analytics, artificial intelligence, enterprise systems, right? So management believes that developing international recruiting partnerships could actually significantly expand the available talent pool, but also increasing the company's ability to support client engagements. So the first expected outcome is, of course, broader access to specialized technical talent, right? Expanding beyond domestic recruiting allows the company to access a much larger pool of qualified professionals, especially in highly specialized technical disciplines where talent shortages are a lot more pronounced. The second expected outcome is improved cost efficiency, right? So many international markets offer access to highly skilled professionals at labor costs which are well below comparable domestic resources, right? So while delivery quality might always remain the priority, a thoughtfully managed global talent strategy can improve margins while also providing additional pricing flexibility for clients. And third expected outcome is increased delivery capacity. So within a larger talent pool and greater recruiting flexibility, right? So the company may be able to support more client engagement simultaneously and also pursue a larger share of available contract opportunities. So this directly supports management's broader argument that there is meaningful growth potential within the existing client base. So from a private equity perspective, so this slide represents a classic value creation opportunity, right? Right. So rather than relying solely on revenue growth, management is identifying operational initiatives that could improve scalability, increase capacity, strengthen margins, and also support future expansion, right? So as you again go through the rest of the book, the rest of the sim, you need to pay attention to opportunities like this, right? So many successful PE investments are not just based on completely transforming a business. Instead, value is often created by identifying a few handful of operational improvements that unlock growth and improve performance over time. So this global talent expansion initiative is one example of the type of value creation lever that an investor might pursue following an acquisition. Um, so yeah, moving on. Any questions, guys? All right. So this builds on the value creation themes that we discussed previously, right? And highlights another potential avenue for growth, which is expanding the company's technical capabilities and qualifications, right? So one of the most important concepts in PE investing is identifying situations where a company already has a customer demand, but lacks the resources, the certifications, the capabilities, or the infrastructure necessary to fully capitalize on that demand. So the management's argument here is that TechNova is in exactly that position, right? So the slide begins by describing the company's existing state. According to management, TechNova has developed strong client relationships and regularly receives visibility into a broader set of contract opportunities than it's currently able to pursue. However, because of limited limitations related to technical certifications, specialized expertise, delivery resources, and in operational capacity, the company is only participating in a portion of the opportunities available within its existing network. So again, from an investor's perspective, this can be an attractive situation, right? Because growth may be achievable without having to fundamentally change the business model or enter entirely new markets. So instead, the focus becomes expanding the company's ability to pursue opportunities that already exist. Management outlines several initiatives designed to broaden the company's capabilities and increase participation in available contract opportunities, right? So the first initiative here is developing additional technical certifications and qualifications. So many consulting engagements, particularly those within the government and regulatory industries, they require specific certifications, right? Technical credentials, security clearances, or specialized expertise before a company is eligible to bid. So by investing in these qualifications, TechNova could potentially increase the number of opportunities for which it is eligible to compete. The second initiative is enhancing delivery infrastructure, right? So as organizations grow, they often need stronger project management capabilities, operational processes, reporting systems, and also delivery oversight structures, right? So management believes that investing in these areas would allow the company to support larger engagements and also improve scalability across the organization. The third initiative they're talking about here is expanding access to global technical talent, right? So I think we discussed this in the prior slide. International recruiting initiatives can broaden access to specialized expertise while also increasing overall delivery capacity, right? So it can help address talent constraints that may currently limit growth. So if we take all of this together, management seems to believe that these initiatives can generate several important outcomes, right? The first outcome is the ability to pursue a greater share of opportunities within the existing client base, right? It's one of the most attractive elements of the growth story here because it suggests that additional growth may be available from relationships that the company has already established. The second expected outcome is deeper client relationships, right? So as TechNova expands its capabilities, clients may increasingly view the company as a broader strategic partner, right? Capable of supporting a wider range of initiatives. So that's a very, very important outcome. The third outcome is expansion to adjacent technology niches and consulting segments, right? So additional certifications, technical expertise, and delivery capabilities, all of them could allow the company to participate in opportunities which are currently outside of its scope, right? So as investors, I think this slide highlights a really important distinction, right, between demand constraints and capability constraints, right? So a demand constrained business struggles because customers do not want its services, but a capability constrained business struggles because it lacks the resources necessary to fully meet existing demand. So management is arguing that TechNova falls into that second category, and the opportunity, therefore, is not necessarily to create the demand, but rather to expand the company's ability to capture the demand that already exists. And it's exactly the kind of situation that private equity investors often find attractive because operational improvements, strategic investments, and capability expansion can all potentially unlock meaningful growth without requiring a complete transformation of the underlying business, right? So that's a very, very insightful slide. Any questions so far? Okay, so this slide highlights another growth driver, but unlike the other slides, this is tied more closely to the broader economic conditions and customer spending behavior, right? So one of the things investors always trying to understand is whether a company's growth is being driven solely by internal execution or whether external market conditions could also provide tailwinds, right? So in this case, management is arguing that there's a meaningful amount of technology spending that has been deferred rather than eliminated, right? So It begins by describing the situation, the current situation, right? So over the last several years, many organizations faced economic uncertainty, budget constraints, inflationary pressure, and concerns about the broader business environment, right? So as a result of that, numerous technology initiatives were either delayed or they were postponed or they were phased over longer periods of time than originally anticipated. So importantly, management is not arguing that these projects disappeared. Instead, the thesis is that many organizations still need to execute digital transformation initiatives, cloud modernization projects, data infrastructure investments, right, and also other technology programs, right. So timing was simply pushed out. So as economic conditions improve and corporate confidence strengthens, management believes that a portion of these different projects may actually begin moving forward, right. So from an investor's perspective, it's an important distinction. Deferred demand can create future growth opportunities because the underlying need for those projects still exists. And in many cases, organizations eventually need to modernize systems, right? They need to upgrade the infrastructure, they need to improve the cybersecurity or enhance the data capabilities, regardless of the short-term economic conditions, right? So management is outlining several initiatives designed to position the company to really capitalize on the potential increase in demand. The first of them they're talking about is preparing for delivery capacity. So if a project activity accelerates, the company needs sufficient recruiting resources, consulting talent, and delivery personnel that's available to support the client requirements. And one of the biggest risks during periods of rapid growth is being unable to meet the customer demand, right? So that's super important. The second initiative is strengthening the project execution infrastructure, right? So as project volume increases, operational processes, project management systems, reporting capabilities, and also the delivery oversight becomes increasingly important, right? So management believes that continued investment in these areas will help support larger volumes of work, but also maintaining the service quality. Another initiative they're talking about is maintaining a flexible staffing model. We talked about this before. An advantage of technology consulting and staffing businesses is their ability to scale resources relatively quickly through a combination of full-time employees and contract professionals, right? So maintaining this flexibility allows the company to respond efficiently to changing client demand while also managing operating costs. So management believes these can lead to several attractive outcomes, right? So first is accelerated revenue growth. If deferred technology projects begin moving forward, demand for consulting services, technical talent, and project support, all of them could increase meaningfully. Second is improved operating leverage. So if utilization rates increase and project pipelines become stronger, a larger portion of incremental revenue may flow through to profitability, right? Because portions of the company's infrastructure is already in place. The third is stronger client relationships, right? So organizations that successfully support customers during periods of increased investments, they often deepen those relationships and create opportunities for future engagement, right? So as investors, I think it's very important for us to recognize that this differs slightly from some of the previous value creation initiatives, right? Because global talent expansion and capability expansion are largely within management's control. The opportunity, however, is partially dependent on broader market conditions and customer spending behavior, right? So because of that, investors typically view these types of opportunities as potential upside rather than guaranteed outcomes. So the key question then becomes whether the company, whether it is positioned to benefit if demand accelerates, right? So management's argument is that TechNova has already established the client relationships, the market presence, and the service capabilities necessary to capture a meaningful portion of the renewed technology spending cycle if and when it materializes, right? So it's another example of investors think about growth opportunities. Some of them are created internally through operational improvements, and others arise from favorable market conditions, right? And of course, the most attractive situations are the ones which it often combines both of those. Any questions on this slide? Right. So the next one, right? This also highlights another value creation, right? It's super important for a business like Technova, which is you want to build a scalable recruiting infrastructure, right? And again, one of the themes we've discussed throughout the sim is that recruiting is the engine that drives growth within many technology staffing consulting businesses. So regardless of how strong a client demand may be, growth ultimately becomes constrained if the organization cannot identify, recruit, and deploy qualified talent quickly enough, right? So as investors, we often spend significant time evaluating recruiting capabilities because they influence revenue growth, delivery capacity, client satisfaction, scalability, right? So again, the client, they start about talking about their current position, the company's current position. Management indicates that the recruiting function remains relatively small and they have significant room for further development. Today, much of the recruiting effort is focused on filling immediate project needs as they arise, right? So while this approach can be effective in the short term, it often creates a reactive operating model where recruiting teams are constantly responding to current demand rather than preparing for future growth. So also, and additionally, management believes that the current recruiting resources can limit the speed at which delivery teams are expanded to support new client engagements, right? So in other words, customer demand may exist, but the ability to quickly source and deploy qualified professionals can become a bottleneck, right? So from a private equity perspective, it's often viewed as a capability constraint rather than demand constraint, right? So because the opportunities are necessarily generating additional demand, but improving the company's ability to fulfill demand more efficiently. So management outlines several initiatives again to strengthen the platform. The first is enhancing recruiting leadership, implementing more standardized hiring process, organization scale. Recruiting often becomes less dependent on individual recruiters and more dependent on repeatable systems. So standardization can improve consistency, candidate quality, and also overall recruiting efficiency, right? The second initiative is building scalable recruiting systems, obviously. So it includes developing structured tools, sourcing process, recruiting workflows, candidate tracking systems, and performance metrics, all of which can support growth across the organization, right? Strong recruiting systems create operational leverage by allowing teams to manage larger candidate volumes without proportionally increasing overhead. The third initiative is adopting a more proactive approach to talent pipeline development, right? So rather than waiting for the client demand before beginning the recruiting efforts, management wants to continuously build relationships with, qualified candidates and maintain a ready pipeline of talent. Can significantly reduce time to fill metrics and improve responsiveness when new opportunities arise, right? So management believes that these initiatives can produce several important outcomes. The first outcome is again supporting revenue expansion, right? So a stronger recruiting engine allows the company to staff projects more quickly and also pursue a larger volume of opportunities without being constrained by talent availability, right? The second expected outcome is increased organizational autonomy. So as recruiting capability mature, individual business units and delivery teams become a lot less dependent on senior leadership involvement for every hiring decision, right? So all of that can improve efficiency and also create a more scalable operating structure. The third outcome is improved operational scalability, right? So with stronger recruiting infrastructure in place, the company can continue growing while also maintaining service quality and operational effectiveness, right? So from an investor's perspective, this slide represents one of the more tangible value creation opportunities that we have discussed so far, because unlike some of the growth initiatives, which basically depend on external market conditions or recruiting infrastructure improvements, these are largely within management control, right? So in many lower middle market businesses, the growth eventually becomes constrained by internal systems, processes, and organization capabilities, right? The management argument is that by investing in recruiting leadership, systems, and also talent pipeline development, TechNova can remove one of the primary constraints limiting future growth. Again, it's a classic private equity value creation initiative, right? Because relatively modest investments in operational infrastructure can actually sometimes unlock disproportionate amount of growth opportunities and also improve overall enterprise value. So again, very, very key value creation drivers that TechNova talks about. And as investors, we continue to evaluate whether it's actually making sense or are there areas where we're not seeing behind some of the assumptions, and what kind of diligence questions do we need to present into the management and be able to get those answers before we go into the investment committee process. Any questions so far, guys? Okay, awesome. So now we are looking at now the important the interesting aspects of the business, right? Which is the fun aspects of the business, which is looking at the financials here, right? So the first here you're looking at financial snapshot income system, right? So you spend time understanding the business, service offerings, market positions, and growth opportunities. Now we're looking at the financial profile at a high level. What we are seeing is a business that has demonstrated consistent revenue growth while also beginning to show improving profitability and operating leverage. If you look at the revenue, it seems to have grown from approximately $10.6 million in 2022 to approximately 12.4 million in 25, with also growth accelerating to approximately 10% in 25, right? So as we discussed earlier in the sim, management believes there remains a significant opportunity within existing client relationships and vendor programs, which help support the growth outlook presented here. But also looking at gross profit, we can see that margins have improved over time, increasing from approximately what is 18% in 2022 to approximately what is 23% in 25. So this suggests that the company has been able to improve the economics of its engagements and also create additional value as the business has scaled. Again, on the operating expense side, expenses have remained relatively controlled as a percentage of revenue. As a result, the company has started to generate meaningful EBITDA after operating near break-even levels in prior years, right? Adjusted EBITDA increased to approximately 430,000 in 25, representing an EBITDA margin of approximately 3%, with management projecting continued margin expansion over the forecast period, right? So the key takeaway is not necessarily the exact numbers themselves, but rather the overall trend, right? So you're seeing a business that appears to be moving from a relatively small scale operation towards a more mature and scalable platform with improving profitability, right? So, but as investors, the question we should be asking is whether the operational initiatives that are discussed through the sim can realistically support the growth and margin expansion reflected in the projections, right? So again, we have a few more exhibits that help us evaluate this, and we want to look at the balance sheet, the revenue bridge, client relationships, end market opportunities, and customer mix to better understand whether the financial story that we're seeing is supported by the underlying business fundamentals, right? So again, as you're reviewing this slide, think about this, right? What are the primary drivers of historical revenue growth? What appears to be driving the improvement in profitability? Are the projected growth rates reasonable given what you've learned about the business so far? What assumptions would need to be true for EBITDA margins to continue expanding? And what additional information would you want to validate management projections, right? So keep those questions in mind as we work through the next exhibits, because many of them will provide evidence either supporting or challenging projections that we see here. And the other thing which you want to look at is the margins are actually super thin. It's not heavy EBITDA margins, right? And again, that ties into some of those conversations about, hey, we are using resources here domestically. Could there be opportunities to significantly expand that by outsourcing some of the talent and things of that nature, right? So just because you're providing a lot of a huge rosy picture around growth, there are certain red flags that you need to start looking at. And in my opinion, the very thin EBITDA margins is possibly an area that you probably have to double click and explore further, right? Any questions so far? Okay. So look at the snapshot, the balance sheet again, right? Again, like income statement, I'm less concerned about memorizing every number, right? I'm more interested in understanding what the balance sheet tells us about the quality of the business and the overall risk profile of the investment, right? So at a high level, what stands out immediately is that it's a relatively asset-light business. Total assets are approximately $3.1 million in 25. The vast majority of those assets, current assets rather than fixed assets, aligns very well with what we learned about the company so far. Is a technology consulting and staffing business, not a manufacturing company or an asset intensive operation, right? So the value of the business is driven primarily by its client relationships, recruiting capabilities, and talent network rather than physical assets, right? So if you look at the current assets, for example, we see approximately $3 million as of 2025. The largest components being, cash of $1.2 million and accounts receivable of $1.5 million. The cash balance provides some indication of liquidity and financial flexibility. The AR balance is also important because it reflects the nature of the business model. Like many consulting and staffing companies, the company performs services first and then collects payments from client afterwards, right? One thing we would likely want to examine during diligence is the aging of these receivables, right? So questions we may want to ask is, are customers paying on time? Are there any collections issues? Is revenue concentrated among a small number of customers, right? So those are all things which can impact working capital and cash flow. So that's very important. In terms of fixed asset, again, another thing that stands out is a very small fixed asset base. A net fixed asset approximately at $40,000 reinforces the idea it's a highly asset-light business. The company does not require large investments in equipment, facilities, or manufacturing infrastructure to grow, right? So as investors, it's generally attractive because growth can often be achieved without significant capital expenditure. Now, you may also want to double click whether those assets are a lot smaller than it needs to be. because again, if you're talking about cloud infrastructure and some of the other areas these guys want to grow, we may want to expand and do some of those capex. But so maybe they are outsourcing, maybe they are having a model where they're not owning those assets, but they are providing some outside outsourced solutions to allow them to manage that as an asset light business. But again, you need to go through a little bit more of the diligence to understand the true nature of those fixed assets that's being presented by the management, and also if there's anything else that's off the books that you need to understand a bit better, right? Again, looking at liabilities, we have approximately 1.4 million liabilities, consisting primarily of accounts payables. Again, importantly, we do not see a significant debt on the balance sheet. It's consistent with the profile of an asset-light professional service business, which is out there in the market. The absence of an substantial debt provides additional financial flexibility and reduces the financial risk. Again, the equity is approximately $1.7 million. The positive equity position indicates that the company has been building value over time and provides further evidence of a relatively healthy balance sheet, right? So the key takeaways from this is that the balance sheet appears to be supporting the overall story that we have seen through the sim. We have strong liquidity, minimal leverage, low capital intensity, and an asset light operating model. So those characteristics are generally attractive from a private equity perspective. Again, like I said before, when we even look at Procare Health, because they can support growth while limiting capital requirements, right? So again, we look at more exhibits. We're going to shift our attention towards understanding where the future growth may come from. Specifically, we'll start looking at the revenue bridge, client relationships, and operating expansion initiatives that management believes can drive future performance, right? So some of the things you've got to think about here is, does the balance sheet appear healthy? Are there obvious liquidity concerns? What additional working capital diligence would you request? How does the asset-light business model influence valuation? And does the balance sheet support the growth strategy described earlier in the sim, right? So keep those questions in your mind, because they will help us determine whether management's growth expectations are realistic or not. Any questions, guys, so far?
Actually, one question.
Yeah, for sure.
Uh, so my question was, for example, this is an asset-light company, right? So
Yeah.
what is the need for debt here in this case? Because generally, when it comes to PE, we take debt and then we try to improve the company, and then
Yeah.
that's the whole process, right? But if it is like a capex, if a lot of capex is involved, I can imagine, like I can understand. But then
Yeah.
in such companies, there's no need for us to take debt or anything like that. So how does PE actually benefit from such deals? Like,
Yeah. So from a P investments thesis perspective, obviously they want to look at deals where they're able to use leverage, right?
yeah,
The context of being able to use leverage in a business services firm such as this is how efficient is the working capital requirements for the business, especially when you look at a lot of like contracts deals where uh, the negotiated the contracts are net 60 or net 90 or net 65, whatever that is, right? And you want to like very quickly expand your workforce and be able to take advantage of opportunities that you may miss because you're not able to like satisfy, like I said, the capability demand versus supply side, right? Are you
okay,
able to very quickly hire enough resources to be able to work on the projects that the customers, the client demand? A lot of times, staffing companies or IT consulting companies, they usually stay off market because when they start off, they feel really comfortable with them. So, like, hey, we're not taking a lot of debt, we're not taking a lot of outside investment. We are basically able to like just keep things super light, right? The reality
right,
sets in when all of a sudden there's a heavy demand for the services, right? And then
okay,
they're competing with someone else who have the resources to be able to hire very quickly. And also
quickly,
then the infrastructure, actually the asset aspect of things also start kicking in because now the client will say, hey, are you able to provide cloud services? You're able to provide infrastructure services. Are you able to handle
okay,
these projects? And you have to make those capex investments to be able to
got
handle the
it.
growth of the client. So there's definitely a need for that. And from a private equity perspective, all we are saying is it allows us to be able to scale those resources to
Okay,
leverage without being caught up into a situation where it's a huge or heavy equipment kind of an acquisition that becomes like very very dicey if you consider that in the long term. Right? Does that make sense?
yeah, yeah, got it. Thank you, Shri.
Perfect, of course, yeah. So the next one here, beyond the balance sheet, again, putting everything together, we understood the business, the service offerings, the market opportunity, the competitive positioning. and the various growth initiatives management believes can drive future performance, right? So it's kind of intended to summarize the investment story into a single page, right? So at a high level, the management thesis is that the company has built a solid foundation of client relationships, recruiting capabilities, delivery infrastructure, but has not yet fully captured the opportunities available within its existing ecosystem, right? So the projections you're seeing here reflects the belief by the management that by expanding their capabilities, strengthening recruiting infrastructure, like I just mentioned, accessing broader talent pools, and increasing penetration within existing client relationships, the company can accelerate growth over the several years, right? So the revenue growth, starting with revenue, we see the business growing again for approximately from 12.4 million in 25 to approximately 19.5 by 2030. Kind of represents roughly 57% cumulative revenue growth over a projection period and approximately 9% annualized growth, right? So what is important here is management is not necessarily relying on a completely new business model to achieve the growth. And many of the initiatives discussed through the SIM are focused on expanding opportunities that already exist within the company's current client base and vendor relationships, right? In terms of the EBITDA growth, perhaps even more significant is the projected EBITDA growth, right? So adjusted EBITDA increases from 430,025 to 1.4 million by 2030. Notice that EBITDA is growing much faster than revenue, right? So it suggests management expects to benefit from operating leverage as the business scales. In other words, revenue is expected to grow while overhead expenses grow at a slower rate, resulting in margin expansion. And then, of course, margin expansion, right? We see EBITDA margins increasing from 3% in 25 to 7% by 2030, right? So whenever we see margin expansion, we should immediately ask what operational improvements need to occur for those margins to be achieved. The growth initiatives we've discussed throughout the similar management's answers to those questions, right? So the expectation is that improved recruiting efficiency, broader talent access, enhanced capabilities, and deeper client penetration will all of them will improve the profitability, right? Again, so connecting back to the investment thesis, right? When evaluating this, it is again important to recognize that much of the thesis rests on execution, right? The company already appears to have an established client relationship, a recurring revenue base, a vendor program participation, a growing recruiting platform, and exposure to attractive end markets, right? So the question for investors is whether management can successfully execute the initiatives required to convert those advantages into the accelerated growth and high profitability aspects of it, right? So basically, right, the four primary value creation levers when we look at it at the bottom of the slide, management highlights the four drivers, right? Capability expansion, which is enabling the company to pursue a broader range of contracts, recruiting infrastructure, increasing the company's ability to source and deploy talent at scale, the global talent access, expanding access to qualified technical professionals while potentially improving delivery economics, right? And then you have digital transformation demand, benefiting from continued technology spending across enterprise and government customers, right? So together, all of these initiatives form the foundation of the projected growth profile shown on this slide, right? So again, you got to think about these things, right? Which of these growth initiatives appear most compelling? Which growth assumptions seem most realistic? Which assumptions carry the greatest execution risk? Do the projected financial results appear achievable based on everything that you have learned about the business so far, right? So if you're writing an investment memo, what would be the primary drivers supporting your investment thesis? Conversely, what would be the biggest risk or concerns that would prevent management from achieving those projections, right? Those are exactly the type of questions that private equity investors ask when determining whether a business is truly investable. Any questions, guys? Okay. So this is a revenue growth bridge, right? What we'll do is we'll take a closer look at where management believes future growth is going to come from, right? One of the biggest mistakes investors make is simply accepting a revenue forecast at face value, right? So instead, we need to understand the specific drivers that support the growth assumptions. So this slide attempts to do exactly that. So management is projecting revenue growth from approximately 12.4 million in 25 to approximately 19.5 million by 2030, representing roughly 57% cumulative growth and approximately 9% annualized growth. The important question is not whether the company can actually grow, right? The important question is how the company plans to grow. So the whole revenue bridge concept, it provides a framework for thinking about the various initiatives that management believes in can contribute to future revenue expansion, right? So rather than relying on a single growth lever, the company is pursuing multiple initiatives simultaneously, right? Which can help diversify the execution risk. So let's talk through each of those drivers. Again, we talked about this before, the capability expansion. First growth driver, capability expansion. Throughout the SIM, management discussed the opportunities to broaden the service offerings, develop additional technical capabilities, pursue certifications that allow the company to qualify for a larger set of opportunities, right? So basically, investors, it raises an important question. How much of revenue is currently unavailable simply because the company lacks certain capabilities or qualifications, right? So if the management can successfully expand those capabilities, then the addressable opportunity within existing relationships may increase significantly, right? Then we talk about the second driver, which is a client penetration, right? It's often one of the more attractive growth levers in private equity because it typically involves selling more services to existing customers rather than acquiring entirely new customers. Management believes a substantial opportunity to increase wallet share within current client relationships, right? In other words, the company may already have access to customers that spend significantly more on technology services than they currently spend with Technova. So if that assumption is correct, then revenue growth can be achieved with relatively limited customer acquisition costs. Then we talk about recruiting infrastructure, right? As we discussed earlier, the company's ability to generate revenues directly tied to its ability to identify, recruit, and deploy qualified technology professionals, right? So in many ways, recruiting capacity becomes a growth constraint. So even if demand exists, the company cannot capitalize on opportunities unless it has the talent available to support those engagements. So management believes that the company, investments in recruiting processes, systems, and personnel can increase delivery capacity and also support additional revenue growth, right? So the next, we talk about global talent access, which is the final growth driver. Management believes again broader access to international technical talent can increase delivery capacity, but also improving flexibility in how client engagements are staffed. So beyond simply reducing labor constraints, global talent access may also enable the company to pursue larger projects and support a wider range of client requirements, right? So this initiative is intended to expand both capacity and competitiveness, right? So again, what you need to be focusing on from a PE perspective is, right, the key question is not whether this initiative sound attractive. Most growth initiatives sound attractive on paper. The real question is whether they're realistic and achievable, right? So think about which growth drivers appear more credible, which growth drivers appear more difficult to execute, which initiative would likely have the greatest impact on revenue, and are these initiatives independent or do they depend on one another? And what diligence would you perform to validate the management assumption, right? So for example, if management believes client penetration is a major growth driver, what evidence would you request to prove that opportunity exists, right? If recruiting infrastructure is a primary bottleneck, what recruiting metrics would you want to see? So those are the kind of things that you want to look at as asking those kind of questions as you go through the thesis, right? The next is, we talk about one of the first questions PE investors ask when evaluating business is how predictable is the revenue stream, right? So revenue growth is important, but recurring and predictable revenue is often even more valuable, right? Because it reduces the risk and increases visibility in future performance, right? So this allows us to evaluate that aspect of the business. Look at the repeat revenue, right? One of the metrics that stands out is that approximately 68% of the revenue comes from a repeat business. It's a very positive indicator, right? So in professional services and staffing business, right, repeat revenue often suggests that clients are satisfied with the quality of service being provided and continue to engage the company for additional projects and initiatives, right? So as investors, we generally rather see revenue generated from existing relationships than constantly having to replace customers every year. And then you have multi-year engagements, right? It also highlights many client relationships extend across multiple years. Very important because it suggests the company is not simply winning isolated projects, but it is becoming embedded within client organizations, right? So longer a relationship exists, the more opportunities there are to support additional projects, expand service offerings, and so on, right? Then you have diversified industry exposure, another positive characteristics. Rather than relying entirely on one industry, the company services clients across areas, like multiple areas. So healthcare, technology, so on and so forth, right? So from a PE perspective, diversification is super important. Then you have revenue stability drivers, right? Also highlights like revenue stability, right? Repeat client engagements. Management indicates that many clients utilize the company across major projects, multiple projects for multiple years. High client retention, strong execution that create customer loyalty and lead to recurring opportunities, right? So as investors, we're not just interested in how much revenue a company generates today. we are interested in understanding how likely that revenue is to continue tomorrow, right? So as a student, you need to ask these questions evaluating, right? How valuable is a 68% repeat revenue? Is the customer base sufficiently diversified? What additional customer concentration information would you want during diligence? How would you verify the client retention claims, and what risk could threaten these recurring relationships, right? So really, the most important, you want to ask yourself, does this support management's argument that future growth can come from existing client relationship, right? Because if a significant portion of the future growth depends on client penetration and cross-selling, then the strength of this relationship becomes a very important part of the investment thesis, right? And then yeah, you got another one, which is like, I think one of the important kind of slides here, as you go through everything, is the understanding when evaluating companies whether future growth depends on a single market or whether there are multiple avenues for expansion, right? So it focuses on that concept. Management believes the company benefits from diversified industry exposure, which not only reduces risk but also creates multiple potential growth opportunities, right? So again, one of those themes where the first growth opportunity, they're looking at management identifies expanding within industries where the company already has established relationships. The second is expanding into adjacent markets. And then you have the healthcare technology, cybersecurity, data. It basically, have healthcare technology adoption, regulatory requirements, technology cloud services, key priorities for organization requiring modernization, and so on and so forth, right? So basically, you're connecting all of this back to the thesis, right? It's important because it helps support the management's growth projections. Management is not suggesting that future growth will come from a single customer, but or a single service, a single industry, but it's a lot more diversified. There are multiple demand drivers, right? It's super important when you look at this thing, right? So basically, and then of course they have direct client relationships. It's kind of the final aspect of the business that PE firms want to look at very closely. How does the company acquire and service customers? So approximately 92% of revenue is generated through direct client relationships, while only 8% are coming through partner channels, right? So that is very important for you to look at, right? As students, you may want to ask, why might direct customer relationships be more valuable than partner-driven relationships? How does this support the client penetration strategy? And what additional information would you want regarding customer concentration, right? Are these risks associated with relying heavily on direct relationships? And how does this slide strengthen or weaken the overall investment thesis? We kind of come to the conclusion of this presentation here. So really the whole idea over here is that as you go through this case study, and basically we go through this practicum, right? Over the last several weeks we've covered many of the core concepts, right? Evaluating investment opportunities, including sim analysis, industry assessment, investment thesis development, diligence planning, and so on and so forth, right? But the purpose of the case study assignment is to bring all these concepts together, right? So later today, I will be sending out the assignment, today or tomorrow, right? I'll be sending out the assignment materials associated with the case study. And the assignment is designed to test your ability to apply the frameworks and methodologies that we've discussed throughout the program, rather than simply recall concepts right from the presentation, right? So you should approach the assignment as if you're working in a private equity internship or analyst role or investment team environment, right? So I want to encourage you to think critically about the opportunity, challenge management assumptions where appropriate, identify key risks, diligence areas, and develop your own thesis, and also build an LBO model based on your underwriting assumptions, right? So remember, in a real private equity environment, there's rarely a single correct answer, right? So what matters is your ability to develop a thoughtful recommendation, which is supported by analysis, sound judgment, and clear investment rationale. And again, the objective of all these practical studies is to help you develop the pattern recognition and analytical thinking skills that PE professionals use when evaluating real transactions, right? So again, the assignment will specifically test many of these concepts, the kind of analysis deliverables will be expected to perform in a PE internship, right? So encourage you to treat this assignment as a real deal evaluation exercise and approach it with that kind of a same level of rigor, right? And next we will move on to a new case study in different industry, continue expanding the toolkit that we've developed throughout the program, introduce several additional concepts which commonly arise in lower middle market transactions, so you gain exposure to a broader range of deal structures, diligence considerations, and so on and so forth, right? So yeah, that's really it. Again, before we wrap up, I want to remind everyone who have not yet scheduled a one-on-one meeting with me to please do so as soon as possible, right? So these are important because it provides an opportunity for us to discuss your career goals, your internship interest, feedback on your progress, any questions you may have regarding the private equity part of the academy. So yeah, feel free to schedule time directly on my Calendly, and I also encourage you to get those meetings on the calendar at the earliest opportunity, right? Really appreciate everyone's participation through the bootcamp and practicum session so far. Looking forward to reviewing the submissions, discussing investment recommendations, and continuing to build your transaction evaluation skills through future case studies, right? Again, thank you again for joining. Look forward to seeing everyone right during the next session. So before I go, any final questions? Any final thoughts?
One question, Shri. So, for example, when it comes to this case study,
Yeah,
uh, in the LBO model, when we're supposed to take the entry multiple, so what is the factors that we need to consider? Like generally, because for ProCare, I remember we have taken the entry multiple as 7.
yeah.
Uh, but then I've just followed it along, but then I've never really thought about why we've taken it as 7. So I just wanted to know, like, is it maybe for healthcare, is it 7, and for IT, is it like 4, 5?
Yeah.
Like, does it depend on that or?
No, it is not, and that's what the lower middle market is very unique. In that it comes through a lot of market assessment. It comes through like partners. They have evaluated deals that happen in lower middle market, and have that understanding that's grown over a period of time. Having looked at a lot of comps, a lot of transaction
Okay.
comps, a lot of deals, the size. It all comes through working. In this industry over a period of time that you actually use as a resource, and you come up with what those valuation multiples typically may look like, and then it gets evolved as you go through a bidding process. You start learning that as you come through internship, where you put your stake in the ground, right? uh,
Yeah.
what you do in a bulge bracket firm is you look at capital IQ, look at all these industry resources, say, hey, I'm looking at all these comps, I'm looking at valuation, right? I'm coming up with a valuation multiple based on all this publicly available information. The thing about
Yeah.
private equity and lower middle market is you don't have publicly available information, right?
Information,
So
yes.
it usually comes with having practice and doing a lot of deals. So my goal for me is, obviously we have a limited number of these practicum sessions where
Yeah.
I'm trying to bring in different kinds of industries and different kind of get you a flavor for what those multiples may look like. But as you
Yeah.
go through internship or even you start a private equity job, as you start looking at more and more and more and more deals, you start getting that pattern recognition of the insights of what those valuation multiples may look like, and
Okay.
combined with going out there, doing some research, getting some industry reports, and getting a lot more information available through the screening process, the initial process. So it's kind of a combination of multiple things that you do, where you
Okay.
figure out what those valuations are. So it is a combination of an art and a science. So
Okay.
there's a reason why I don't talk about those multiples upfront, because I want you guys to give it a try, and have a
Okay.
conversation, and then we can have a one-on-one session where we talk about, hey,
Yeah.
your assumption, and let me give you my feedback of what it seems to look like. So you start going through it. We literally have just done one case study before, which is ProCare. But
Yes.
as you do more
Yes.
and more of these case studies, you start getting the pattern recognition, and you start getting better at this process.
Oh, thank you. Thank you.
Great. All right. All right. Great, guys. Thank you so much for showing up, guys. I know it's a Friday late evening for you, but really appreciate your time, and have a wonderful weekend. And I'll be, Anita or myself will be sending out the assignment most likely tomorrow. But other than that, have a wonderful weekend, and let's catch up next week. Okay.
Thank you. Thank you, Shri. You too. Bye.
If you would like to continue learning how private equity investors evaluate real lower middle market acquisition opportunities, I invite you to join the GEX Private Equity Academy Insider List. As an Insider List member, you will receive our complimentary private equity starter kit, transaction insights, educational resources, and invitations to select live private equity case study sessions. If you found this episode valuable, I would also appreciate if you subscribe to the GEX Private Equity Academy YouTube channel so you do not miss future podcast episodes, acquisition case studies, and other educational content. To learn more or to join the insider list, visit www.gexprivateequityacademy.com. Thank you again for joining me. Until next time, keep asking better questions, keep evaluating opportunities, and remember, do not just look for great businesses, look for great investment opportunities. Thank you.